So welcome everybody to Retire Well, the podcast where we explore how to plan, invest and live well in retirement. And I'm Jim Smith.
And I'm Martin Fox. Together we'll be exploring how to make your money work for you, as well as how to live a purposeful and healthy life from midlife and beyond.
So coming today, we're delighted to be joined by Dean Anderson. Dean is the CEO and founder of Kernel Wealth.
We'll be talking about investing, what really matters for long-term outcomes, and some of the biggest mistakes that investors tend to make.
So talking about investment mistakes, Martin, one area we often see investors trip themselves up is reacting to news and tinkering too much with their investments.
Yes, there is usually someone on the internet or a podcast with a very confident opinion.
Yes, and a chart.
Always a chart.
Yes, encouraging us to make sort of changes, buy some new funds, buy the latest investments, say gold, or perhaps just generally doing some unnecessary trading.
Yes, when in reality all this tinkering does is provide more opportunity for us to get it wrong.
Yeah, you might call it hands-on learning.
Yes, you might. But when you step back, investment success actually comes down to a few fairly simple steps.
Yeah, like having a plan, sticking to it and keeping your costs low.
Yeah, and then try not to interfere with it too much, which is arguably the hardest part.
Yeah, because doing nothing often feels sort of unproductive.
Yes, yeah. So historically, Jim, when you've heard people discussing investing in New Zealand, it's usually dominated by one topic.
Yes, property.
Yes, property. Buy a rental property, then another rental property, and if it's going well, buy a few more.
Yeah. But to be fair, though, that's worked for quite a long time.
It has, yes. Yeah, it has. But it is good to see that things are finally changing and people are thinking more broadly. Other options like KiwiSaver, managed funds, diversified portfolios.
Yeah, and ways to build wealth that don't require you to fix a leaky shower at 12 a.m.
So I think today's conversation is really about cutting through some of the noise.
Yeah, focusing on what really matters.
And helping people make better long-term decisions without overcomplicating it.
Yeah, so with that, let's bring in Dean. On today's podcast, I'd like to be joined by Dean Anderson. Dean is the CEO and founder of Kernel Wealth. Kernel is one of the key players reshaping investing in New Zealand, particularly around low-cost, transparent and accessible investment solutions. Dean brings an interesting perspective on where investing is heading in New Zealand, what really matters for long-term investors, and how Kiwis can make better decisions. Dean, thanks for joining us on the podcast.
Hi, guys.
So, Dean, for those who haven't come across Kernel Wealth before, would you mind starting by just sort of briefly introducing you and your business and what Kernel is doing differently in the investing world?
Yes, we've been around for 6 years now. Ultimately, Kernel is an investing platform, but we're also a licensed fund manager running a broad range of investment funds and KiwiSaver scheme. And ultimately, we're here to help Kiwis better build, understand, and enjoy lasting wealth. And we do have quite a big focus on outcomes and what are the things that build good investing habits and align to customers' long-term interests. So typically think about that as sort of very goals-based investing and helping people achieve those big life milestones.
Oh, great. So what do you think most people or even advisors get right or even get wrong when it comes to investing?
Yeah, I think the common thing that we will typically see, and this is across the board, this is people that are in the industry as well as mum and dad DIY investors, is typically we overcomplicate things. We overcomplicate the portfolios. We overthink in terms of the importance of maybe an individual stock or an individual fund, rather than actually spending more time on the thing that drives probably 90% of the outcome, which is getting the big picture right, creating the right habits, getting those goals in place. I think we tend to jump to and spend most of the time worrying and thinking about the individual investment rather than actually that bigger plan. And without a plan, you're not likely to achieve the right outcome.
Dean, can you talk us through Kernel's approach to investing and where you sit on the active versus passive debate?
Yeah, look, so it's a long-running debate, and this is ultimately at one end of the spectrum. You have fund managers that are trying to pick winning stocks and winning times, and at the other end is the sort of just own the market or part of a market through an index-based strategy. We're not religious about this thing at all. I think too often this has been polarized as kind of an either-or scenario. Instead, I'd much rather actually think of Kernel as a data-led business. We're a data and technology company. That's our mindset, and we follow the facts and the data. And so when we look at that information, we look at some of the data reports that exist in the long-running research, it's pretty hard when it comes to things like equities to outperform consistently over the long term. And so, we index our global equities and domestic equities on the funds. But then in asset classes like cash and fixed income, the market structure is different. And the data clearly shows it's much easier to create additional outperformance for investors. And so that's where we are more active and hands-on. And then, of course, when it comes to things like building a diversified fund like KiwiSaver, most KiwiSaver investors are going to be in a diversified fund, conservative, a balanced, or a high growth. Ultimately, that's an active decision. There's active decisions that have to go into what is that mix of assets looking like. So, we sit in the middle there. We're not religious about this. We really think about ourselves as a data and technology company, and we look at those facts and take that information. And if those facts change, we will change rather than actually just stick blindly to one sort of storyline.
Thanks, Dean. Fees have come down a lot in recent years. Why should investors pay attention to fees, and how big a difference do they really make to their outcomes?
Yeah, fees. Fees are often portrayed in our industry as percentages, and they may seem small on paper, but they actually really add up over time. So when you're talking about a 1% fee, sounds small, but actually as a proportion of a typical long-run return, it's actually quite a large weight. And so ultimately, that is something that you can control. The cost of your investing is something you can control. And the more you're paying away in fees, the less returns that you're keeping and the less returns that you have to keep compounding. And so we have this conversation often around what is the total cost of investing. But I think I sort of draw the picture a bit broader than actually just the management fees. Management fees are the thing that we see most of the conversation on. And the reason being is quite easy. Is you can look at a product disclosure statement and you can compare KiwiSaver A to KiwiSaver B and those two fees. And, a typical high growth fund, for example, in New Zealand, I think the average fee is close to about 1.2%. Whereas, say, a Kernel fund at 0.25%. So, instantly that means that higher fee fund every year has to do at least 1% more just to be neutral, right? So they've got a bit of a headwind anyway. But there's more than just the management fee. And I think Kernel has always been focused on, and part of the genesis of why we even launched was that there are a lot of hidden costs in our industry. Things like the way that taxes optimize, the transaction fees, all these other little costs that add up and eat into an investor's return over time. And, we know that ultimately, the typical consumer on the street probably is not that familiar with tax and not wanting to spend the amount of time looking into that. But again, just like a management fee, these are costs that can eat into returns. And that's, again, a role of an advisor to sit there and help people understand the whole cost of an investment decision, not just the number they see on a paper.
Okay, so keep an eye on the fees. If someone wanted to build a solid and simple investment portfolio today, what are the key building blocks?
Yeah, so this sort of goals-based investing, I think aligning your sort of portfolio design to a goal is becoming increasingly popular, and I think it's a great way to think about getting the right outcome. Often we may blindly be just trying to put money aside, and you're not likely to achieve that goal. My goal is to have $10 million, right? That's irrelevant. The numbers that you're trying to aim for don't actually mean anything. It's working out what are you trying to achieve from your life. And so, again, a great role of financial planner will be sitting there and going, okay, we've got a long weekend coming up. Maybe it's a great time for a couple to sit down and go, well, what are we wanting to achieve in our life? And that may be things like we want to retire at 55, and this is the income that we're going to need to maintain the lifestyle that we want through retirement. And so that's your start point. And once you know that, then you can work back and go, great, we've now got 15 years before we're going to start to need to draw down from our investments or want to take an income from those investments. So 15 years, long horizon, we're contributing to it. Long time horizon, that means, okay, you're going to then know where you want to sit on that risk profile. So again, bringing it back to the KiwiSaver analogy, 10, 15 years, you're going to be sitting more towards a growth or a high growth type risk profile fund, i.e. mainly investing in shares. And so that's that sort of goals-based building block. And today, outside of KiwiSaver as well as within KiwiSaver, there are a lot of great options for preset diversified funds. So if you don't have an advisor building your portfolio, or you're doing this yourself or starting small, you can find diversified funds, conservative, balanced, high growth funds that are readily available outside of KiwiSaver. And frankly, they're actually just a great place to start for most investors. They're broadly diversified across asset classes and countries. Everything's kind of taken care of, and you can just match up the profile that you have with the particular goal that you have.
Oh, great, thanks, Dean. So KiwiSaver has really grown considerably over the last 5, 10 or more years. Where do you think KiwiSaver gets it right, and where do you think it could still improve?
I think overall, KiwiSaver in New Zealand has been broadly successful, right, for a non-compulsory scheme. If you look at the participation rate of those that are in the working class, it's very high. So, people that are working are typically actively contributing to KiwiSaver. Outside of that, engagement is relatively low, though. And so I think one of the issues that I have is, okay, with a lot of the political discussions and what we've literally just had on the 1st of April is now increasing the contribution rates. And that's starting to line us up or move us closer towards the Australian regime, who have had a very successful superannuation. So contribution rates are going up. That's good. That's for savings habits for us as individuals. That means that we should have more in the pot when we come to retirement. But there are things around that I think we should be looking at. And so, I think that's that conversation about, okay, what's coming up with the election, but how do we make more Kiwis incentivized to actually want to contribute into KiwiSaver and get them started earlier? Because if we go back to that compounding sort of conversation, the earlier that we get people engaged and saving, even small amounts, is actually material difference to what they're going to have in their retirement when they reach that age.
So you mentioned the election. Obviously, 2026 is the election year in New Zealand. What policy signals or changes are you expecting or looking out for that could impact sort of investors in KiwiSaver?
Yeah, so the main one that we've seen so far is the contribution rate, so increasing contributions. I worry that we'll end up like maybe the last election where you're going to see too much of this tinkering, and it's kind of happened already actually, because National has come out with their policy obviously to enable service workers and farmers to buy effectively investment properties via KiwiSaver. Clear vote grab, I can kind of get the intention, but the risk we have with those sort of policies in the big picture is it starts to erode the strength of KiwiSaver being a long-term retirement bucket into becoming a multi-use, politically influenced savings pool. And so I worry about that, and what we may see this election was sort of the dangling of carrots to entice small segments of voters. What I would love to see more broadly is, again, one of the policies, and we've written a bit of a guide on 3 or 4 points that we would love to see discussed at this election. But the one I sort of am most passionate about is, again, creating that early engagement. And this is important for New Zealand's long-term financial well-being. And so at the moment, many of us may have remembered that we've rolled out, or the government is rolling out, financial literacy programs in school. Now, that's great. It's a really important skill set that we all need to have. But it's also quite hard to talk to a 16-year-old about retirement and something that's 50 years away. So one thing I would like to see is a reallocation of the current government tax contribution to your KiwiSaver. So obviously that's now been halved. We are now, and it's also got a income cap as well. So every year, if you were contributing $1,000, you used to get your $520. That's now halved. It's now 280 odd or whatever it is. And if you earn over 180, you don't get that. It makes sense that the government halved that because we were spending as a country, you, me, everybody on this call was contributing to $1 billion a year going into those tax credits. Now, that was mainly ending up in the pockets of middle income tax earners, not actually changing anybody's savings behavior. So a nice little carrot for middle income earners, not actually changing any of our savings behavior or our retirement outcomes. That was $1 billion a year, now $500 million. If we redirected that money and instead put it into contributions for kids KiwiSaver from 0 to 16, that's going to make a massive difference. That does change the narrative for New Zealand. It means that when somebody is talking about financial literacy in school, they've got their own dollars in their own account that is tangible and means something to them. It's giving them a head start in life, so they've got some financial buffer as they start into the workforce. And so, I think those are the policies that we should be discussing. They're much more impactful for New Zealand. Just specifically, though, I think there is one thing that I do think we'll probably see this election, depending on how the economic environment plays out, of course, and how tight the votes may be. But we are clearly going to have a conversation soon about superannuation age. And at the moment, KiwiSaver and superannuation are coupled. They are both tied to 65. I think many Kiwis would buy into the idea of increasing superannuation to 67 if KiwiSaver access age was decoupled, and I would argue lowered to something like 60. By decoupling those age points, it gives people more choice and control of their financial future. So you've got people who are blue-collar workers or builders or tradies, and actually at 60 years old, you've probably had a hard run of work and actually maybe wanting to consider retirement. By enabling people to access KiwiSaver at 60, it gives them that choice. And that you've still got the backstop of superannuation at 67. So look, whether this gets brought up this election, I don't know, but we are conscious, I think, that clearly the superannuation age and the cost to the country of funding superannuation is going to come up sooner rather than later.
Yeah, thanks, Dean. Very interesting. So property has historically been sort of the go-to investment or asset class for Kiwis. How do you see that mindset changing over the next 5 to 10 years?
Oh, look, I've noticed a change. I've been there. I've done it. I've done the property thing. First property was in Wellington, and this is 12 years ago, and it was 5% deposits. Still relatively low interest rates, and so the benefit of leverage was amazing. But I do think, even my experience, that's changed, and we're at the tail end of what has been a 50-year tailwind for this asset class. Interest rates fell for the last 50 years, basically, which was a fuel for property prices. The second factor that people forget is that we've also gone from single income household to double income households. And so broadly speaking, we've absolutely stretched the limits in terms of those things that have fueled property prices. So, the property value to income levels is now sort of at the extremes. In some cases, like Auckland, it's typically 9 or 10 times. We can't earn more income as a household because we're now both out working if you're a couple. And interest rates have fallen from highs down to, we hit our low point and now probably trending back up again. And so I think the things that have made property so successful for so long aren't there anymore. So I think there's been a generation who have felt they were very smart, and they have been. But really, the only thing that you really need to do to be smart about it was just buy an asset and leverage up. That was the only smart decision you had to make. So I think we're seeing this shift now. When I think about speaking to people in their 30s, 40s, 50s, the desire for investment property has fallen away. You've got a busy life. You've got work to worry about, social pressures. You need a lot of capital. They're probably negative cash flow. The returns are questionable. So I think there is a mindset shift now, and people are going, actually, property is not the only way to build wealth in New Zealand. And people are looking at, okay, how do I invest in the share market? How do I invest in funds? And you can have just as good a financial outcome, if not better, through that approach. So the shift has happened. And even the regulatory barriers, I would say, like I've recently was involved in trying to rent out a small part, separate property that I had on our home. And my God, the healthy home standards, the legislative work now and the paperwork that you have with also property investing is incredibly high. And so, yeah, it's not an easy game. And I think many people have now realized as well in the last couple of years that it's also not a one-way bet. So, my prediction here, the property game has sort of changed a corner now, and I think mum and dad investors are going to be looking elsewhere.
Thanks, Dean. If you had to give one piece of advice that most investors would ignore but shouldn't ignore, what would it be?
It ties back to that thing that we often do wrong, which is I think most people need to spend more time focusing on their own behaviors. The thing that trips us up when it comes to investing is letting our own emotions dictate our decision making. Investing is very emotive, and surrounding it is often very dramatic headlines. What we're seeing today, every day you'll log into the newspaper and you'll see flashing red breaking news. And we've had, a bit of a grind of 5 years where we've had, pandemics, wars in Europe, inflation we've not seen in a generation, and now another geopolitical war going on. And so it's been non-stop major news and events. And I think that can easily influence many of us to either pull out of investing, change our KiwiSaver down to cash. And those are the things that will trip us up. That's the thing that trips most investors up. And so working on your own control of those emotions and realizing that the behaviors you have are the thing that's going to dictate most of your financial outcome is key. And so some great tips there is get support from a financial planner if you need it. Automate your investing. So again, it's less emotion, more about just behaviors. And then obviously a simple one, don't log in. You're not touching your investments for 10 or 20 years. You don't need to check it every day.
Thank you, Dean. If someone is listening and they're in their 40s, 50s and 60s and they want to improve the outlook for their retirement, what are the key steps they should take?
So obviously, the earlier we start, the better, right? So one thing I'd always encourage, if you're in that age bracket and you've got kids or grandkids or relations that are younger, start having a conversation. I think there's a duty for all of us to have those conversations about money earlier. But people in that 40s, 60s age bracket, that is your prime money-making window. That is typically where most of us are going to be at our peak income earnings. We're going to have assets, we've got access to leverage. And so you're still in that accumulation phase and you're trying to set yourself up for the retirement point, at which point you're going to transition to wanting to draw down or take income from those assets. And so having a clear plan there about how you're going to maximize that income, how you're going to invest that money to get to that retirement point is key here. And again, most people, if you're in that age of being fortunate to buy a house, it's not necessarily just pay down the mortgage. A bit of leverage is actually perfectly fine within this bracket. Because again, what happens is a lot will typically then get to retirement and want to downsize. So you're trying to look at the big picture here and go, where do we allocate our money and how do we invest it for maximizing the size of the pot that we're going to have when we get to 60, 65, 70, when we're going to start to transition and reset our portfolio into a more income-based approach. So come up with a bit of a plan, work out what that timeline looks like, how long are you going to be working, and where do you think that point is that you're going to want to shift from contributing to actually starting to draw down. And that's going to determine what the profile is of your investments, how much you want to really be saving up now, etc.
Finally, Dean, you are the CEO of a successful and fast-growing investment firm. How are you thinking about your journey into retirement?
I think on the personal front, it's no different to probably actually many small business owners in New Zealand, right? I was renting for the past sort of 8-9 years when I'd moved to Auckland, sold everything, was renting, and then basically put every single dollar into a business, right? And I think that's the journey of many small business owners, that business becomes your 100% focus for a long period of time. It takes all your energy. And that is something that hopefully for many of the 250,000 on small business owners out there becomes a key part of their nest egg. More recently, though, I think it's that, worked hard, you get that business to a point where actually now you can start thinking a bit outside of that. And so for me, that's meant, now re-entered the property market, bought a home rather than now renting, and making sure that my investments are building up outside of the business as well. And so that's both KiwiSaver and cash flow into general investing. And again, I'm one of those great examples of, even though I'm in the industry, I keep it very simple with just taking a preset, diversified, high growth fund. Even living and breathing every day, the mindset to be thinking about my portfolio and what's changing in the world is too much mental tax for me. It's just the cash flow going into the investment pot and doing its work for the next 40 years is all I want to think about.
Awesome. So Dean, thanks very much for joining us. Really enjoyed the conversation. Appreciate you taking the time and sharing your insights with us. Thanks for joining us on the Retire Well podcast.
Thanks, guys.
Well, that was a great conversation with Dean. I think one of the big takeaways for me was how investing often gets overcomplicated.
Yeah, exactly. We get caught up focusing too much on chasing returns and selecting last year's best performing fund.
Yeah, when really it's the bigger picture that drives most of the outcome.
Yep. Having a plan, sticking to it, and building good habits.
Yeah, I liked what he said about having a plan and how you're probably not going to get the best outcome.
Yes, goals first, investment second.
Which sounds obvious.
Yeah, it does, but it isn't always how people approach it. Jump in, do the fun part of buying the investments first, and then leaving the planning to later, if at all.
Yeah, and another takeaway for me was what Dean had to say about fees.
Yeah. People don't always feel like they're paying that much at the time, but over the long term, fees can add up significantly.
Yeah, and one of the fees are one of the few things that as an investor you really can control.
And perhaps the most reassuring part was even someone like Dean, who lives and breathes investing, keeps his own approach relatively simple.
Yeah, which is probably a good reminder for us all that you don't need to overcomplicate things.
No, but getting those fundamentals right, your plan, your costs, your behaviour can make a really big difference over time. Well, that about wraps up episode 6 of Retire Well. Thanks for tuning in, and a big thanks to Dean for joining us.
If you find the topics helpful, please consider giving the show a like and subscribing. You can also drop us a comment if there's any area of finance, retirement planning, or how to live your best life from retirement that you'd like us to cover in future episodes.
See you next time.
On today's podcast, delighted to be joined by Dean Anderson.
Oh, wrong button, sorry. Just started again. The wrong
Well, look, at least there's no shortage of reels for you guys to use on social media, right?